Anyway, last week, as interest rates were kept on hold, the Reserve Bank was encouraged by economists, including Warren Hogan, to be more upfront in dealing with expectations about future rate movements. Both Hogan and HSBC Chief Economist Paul Bloxham say the next move in interest rates is more likely to be up and not down. Well, today, the RBA Deputy Governor Andrew Hauser spoke pretty frankly about all that.
Or sort of a fanatic to think that future rate cuts could be coming. More plausibly, perhaps, at the moment, you might worry about how much remaining room there is, given that picture of capacity pressures. You might think the economy is a little bit boxed in by our supply capacity.
Well, Warren Hogan joins me now. Warren, many thanks for your time. Effectively there, Andrew Hauser saying, hey, we're not saying that interest rate cuts are off the cards, but effectively by saying that the 3 interest rate cuts so far have meant that there's been demand that's come into our economy, but there has not been the supply side to match it. Now, that's the reason why you get inflation. That's the reason why it's nudged up, because business hasn't got the confidence to go out and invest right now.
Yeah, well, business investment, as the Deputy Governor noted today, has been flat for the last year or so. There's a lot of business borrowing, a lot of investment in commercial property and other structures, but that capacity, skills, the broader capacity of the economy doesn't seem to be expanding. And of course, the key point from the Deputy Governor today was that we have a starting point for this new growth phase in our economy with very little spare capacity, which is unlike any period in the last 30 years.
Well, that's precisely what he pointed out. So they're saying they started to cut interest rates ahead of, if you like, the numbers being completely right, because they wanted to try and stimulate a bit of extra, sort of economic growth in Australia's economy. Broadly, they think it might come, but it's been delayed. It hasn't happened. And that's a fundamental issue, because what's really happened is they've stoked inflation instead.
Well, it looks like it, but we've only had that 3 months. We'll wait and see over the summer. But
you wouldn't have to be a rocket scientist to work out. If you look at cafes full, aircraft full, house prices going up, you wouldn't have to be a rocket scientist to work out that inflation might be a little hotter than what they'd like.
It is, and the problem they've got is that they never sort of raised rates enough, never slowed the economy enough to find that spare capacity, because the only way you get the business investment, the expansion of the capacity, is to trigger demand, is to trigger the consumer. They've done that. That's been going on for a year. It's been a bit patchy, but it's been good in the last 6 months. That, of course, lifts business activity, lifts profitability, and, of course, then lifts investment. That's coming down the pipe in 2026. I'm pretty confident of that. But of course, we're starting from a position of no spare capacity, and any demand, whether it's consumer or business investment, is going to put some upward pressure on inflation. And that's why they probably should have hiked more originally.
But here's the real issue. The government has gone out and spent a whole bunch of money and continues to spend. Now, they're trying to rein it in at the edges, but let's be honest, it's off the chain in some ways. And so as a result of that, you've suddenly got a situation whereby the Reserve Bank can't be left to do all the heavy lifting on its own. This is fundamentally the issue that we've got going forward, that really, if you suddenly get big wage claims coming out of the private sector and the public sector, again, that's going to continue to fuel that inflation number.
Exactly right. And I think that's the big next risk, is what happens to wages over the next 6 to 12 months. They're starting to show some signs of bottoming out. With no productivity, it's already an issue. But if they start to rise again, that's really going to push up business costs. And the government does deserve some accountability for this, because of their big lift in spending. That, of course, means that they're sucking in resources which could have given us that wiggle room on inflation.
But I keep hearing the Treasurer saying, hey, it's not us. Talk to the Reserve Bank Governor. They always say it's not too much government spending. Everybody knows it's too much government spending. Everybody recognises that the government has gone out there and filled the gap of private enterprise when it came to spending, and they did it all with borrowed money.
Yeah, it is borrowed money. And, of course, the economic consequences, the hardship, whether it's inflation and declining spending power, whether it's a disruption in the economy, whether it's a big recession. This comes with time. It doesn't happen straight away. So if this all does go badly, if we do get a burst of inflation, if rates have to go up a lot, and then we have a recession, I think we can have a look at the government and its expansionary policies into a major inflation shock. that bears some responsibility.
Okay, so markets say the next rate cut, if it's ever going to come, is probably in June next year. It gets beyond 50-50 chance from markets. But you still say there's a chance rates might actually go up. You can see the rate cut odds here, right? So, but you're still saying there's a chance they could go up.
Yeah, well, the market's not going to price in a rate hike until it's imminent. So I think we're more than likely going to be talking about rate hikes by the time we get back from the summer holidays. And I think May is when you get the first opportunity for a rate hike. The sooner they do it, the less they have to do.
So, Warren Hogan, many thanks for your time.